Coming up into the last lesson of the market maker model section, we're going to be talking about the silver bullet. The silver bullet. What is the silver bullet? It's advanced market structure, and we'll show you in some charts later how that looks like. But first, what is a silver bullet? The silver bullet is the second stage of accumulation in a market maker buy model, or it is the second stage of distribution in a market maker sell model. And the hardest part for most traders is being able to identify the stages in the moment as price is printing live. So how do you know that this next leg is the silver bullet, and why is the previous high or low the low risk sell or the low risk buy in that market maker model, or as we call it, stage 1? We do not need to know the low risk buy or the low risk sell in the moment as price is printing. We know when the silver bullet is going to be forming by understanding intermediate term highs and intermediate term lows. This is all about market structure. An intermediate term high is a high that has a short term high to the left of it and to the right of it. And an intermediate term low is a low that has a short term low to the left of it and a short term low to the right of it. So the intermediate term high or the intermediate term low is where you place your stop loss. That's the high or low in the structure you don't want to see get violated. There are two ways to trade the silver bullet. Trading after a confirmed intermediate term high or intermediate term low has formed, so it has a short term high or low to the left and a short term high or low to the right of it, or we're going to anticipate that intermediate term high forming and trading that short term high or short term low that will be forming next to it. So over here we got a crude depiction of how a market maker model looks like. We got that again original consolidation up here, right? And then hitting a key level once again where the smart money reversal should occur. Now breaking structure up here, and then the first area over here, that is the low risk buy in a market maker buy model. We're not looking for this, we're looking for that second stage of accumulation in this market maker buy model. So looking at all the lows and highs being formed around in this area, we can see this is a long-term low. Now why is this a long-term low? It's the extreme low in this whole range, and it has a short-term low to the left of it and a short-term low to the right of it. So this is a short-term low. Now once we start to break up further, there will be more short-term lows being formed in that whole range moving up, and we are waiting for that short-term low after the low risk buy to get rated, and then we form that intermediate term low. So we expect price not to exceed this intermediate term low once again. We call that a protected low. So in anticipation of that intermediate term low forming, we can see the second stage of distribution forms after we form that intermediate term low. So essentially you're going from this external range liquidity, right, this short-term low getting rated into another price leg up, and inside this another price leg up we anticipate a short-term low forming, which is the silver bullet, right? So this is an entry model for second stage of the distribution or accumulation phase. Referring back to the other lessons, right, mitigation blocks, we can use all those techniques to solidify our trade idea where that short-term low should form. We've got that mitigation block on the sell side of the curve, extending it out in time, right, to the buy side of the curve. We see this intermediate term low forming, and it is only an intermediate term low once we form a short-term low to the right of it, right? So we need to have a short-term low to the left of it and then a short-term low to the right of it. And this is the silver bullet entry model and second stage of accumulation. So this is option number 1, anticipating that short-term low to form next to that intermediate term low. So this is option number 2, right? And this is, we're waiting for that intermediate term low to be confirmed. So we need to see that short-term low to the left of it and that short-term low to the right of it, and then we have a confirmed low. So over here, same sort of depiction, only slightly different market structure, right? We've got these equal highs getting rated, but we also have these equal lows down here, which are short-term lows, and we're expecting that intermediate term low to form below this short-term lows after that smart money reversal. And remember that smart money reversal needs to happen in a discount array. Sell side of the curve, smart money reversal, and forming that long-term low, right? Because this is the extreme low in this whole range. Short-term low to the left, short-term low to the right, and that intermediate term low forming will be inside OTE levels of this range, right? So intermediate term low has been confirmed after we form another short-term low to the right of it, right? So then this is accumulation phase 1 because this is now the low risk buy. And in the previous schematic we saw price action drop into this area over here, creating the low risk buy already and then continuing up, and then we wait for that intermediate term low, right? But over here that low risk buy is in fact that intermediate term low. So remember, you need to have a short term low to the left of it and a short term low to the right of it. Accumulation phase number 1 happens over here, then we expand higher again, and then the silver bullet is forming, which is the second stage of accumulation. Again, thinking back about order pairing, thinking back about mitigation blocks and that kind of techniques, right? We can use that mitigation block once again. So this could be a bearish order block, right? We violate that bearish order block, and once price trades back into it, we can use it as a mitigation block to offload those short positions and go into long positions from smart money and completing that market maker buy model above that original consolidation. Now for a sell model, same thing, only inversed, right? We've got that original consolidation to the bottom over here, going into buy side of the curve, and we need to hit a key level, right? So smart money reversal over here, dropping below this market structure low, creating a break of structure. Low risk sell occurs over here, and then we go into the first distribution phase. Now we need to see an intermediate term high form, right? Because we're on sell side of the curve. So what do we need to have? We need a short term high to the left of it and a short term high to the right of it. Right? So low risk sell, short term high, another short term high is formed, and then that intermediate term high is being formed. We could have a bearish order block inside this price leg up over here, and that makes sense that this high will hold, right? And this is option number 1, right? We anticipate this short term high forming over here. So our entry is in anticipation of that short term high forming to the right of it, right? Looking at it from a different perspective, option number 2. Again, we drop lower, breaking structure after that smart money reversal, right? Short-term high to the left, long-term high, and then another short-term high to the right of it. Now we need to wait for that intermediate term high to be formed. We wait for a rate on liquidity of those short-term highs, which happens over here, right? So now we wait for a short-term high to get created to the right side of it. So we have one on the left side and one on the right side, creating this intermediate term high, and then distribution phase 1 happens, and then breaking down lower, and here is where the silver bullet forms, right? Again, think about those mitigation blocks, right? There could be a bullish order block over here, which is violated, and then price trades back into that, creating that mitigation block to offload those long positions from smart money into sell positions and creating a down move which will liquidate that original consolidation. Here another schematic, and then that mitigation block happening a little bit earlier, right? So you have multiple areas of mitigation blocks, right? We use those bullish order blocks on the buy side of the curve and extend them out to the sell side of the curve. So over here we've got that intermediate term high forming around that mitigation block, and once it breaks lower, that short term high forms inside that mitigation block, making it a very high probable silver bullet setup. So the second stage won't form this way every single time. However, the majority of the time it will. So if you stick to this rule, you will see a lot of success in identifying and trading it. When you see this structure form at the highs when bearish or at the lows when bullish, at the key level, importantly, and you're using time frame alignment, it's very likely that the market is and has turned and is looking for the opposing liquidity or discount and premium levels. Right, so we got a Australian dollar, US dollar daily chart, right? Again, keep in mind every time, right? External range liquidity into internal range liquidity. We rate this external range liquidity old daily high. Where does your eye go to, right? We have an imbalance down here. So our draw on liquidity is down here. So now we know this high over here is unlikely to get traded into again, and our next draw on liquidity is to fill up an imbalance or reprice into a fair value gap, right? Because the algorithm only does two things, which is running old highs and lows, right? And repricing into imbalances and inefficiencies. Now we see this big daily candle completely filling up this fair value gap on the daily time frame. Now we drop down into a 1 hour chart, right? How are we going to identify where to get in, right? We wait for that intermediate term high to form, right? And then we look for that silver bullet setup. So look at this chart for a bit and see if you can spot the silver bullet. Right, now let's look at market structure, right? What do we need? We need a long-term high above an old high, right? We need that smart money reversal. So we have a short-term high here, long-term high here, short-term high here, right? And now we wait for that intermediate term high to be formed. So how does that look like? Right, smart money reversal above that old high, breaking down lower. And what do we have down here, right? Low resistance liquidity or engineered liquidity. So our drawn liquidity gets better every time when they engineer liquidity on the sell side. Price trades back up into OTE levels or premium level of this range, right? Creating that low risk sell, forming another distribution phase, dropping lower, and then the silver bullet is the second stage of distribution and it forms over here. Now let's look at the different highs, right? We have a short-term high here, long-term high here, short-term high to the right of it. Now we need to wait for that intermediate term high, which is forming above over here, right? And now we need a short-term high to the right of it, which is over here. And this is what it looks like, that intermediate term high, which is also the low risk sell in this occasion, right? So we don't get in over here because we waiting for that short-term high to be formed, right? Which is over here, and then price drops down lower, and now the silver bullet is activated in the second stage of distribution. Now we're looking for a mitigation block, right, or a breaker block. We use those bullish order blocks from the buy side of the curve and extend them out in time, right, and use them on the sell side of the curve. And we can see over here we got this breaker and mitigation block which is being tapped into. You could use this one, you could use the wick of this one too. This is overlapping and it's high probable that the silver bullet will form over here, which is another short-term high, right? Continuing down and filling up that daily fair value gap, which is the draw on liquidity. So we got gold futures chart over here. Again, external into internal, right? Keep that in mind, order pairing. We've got these buy stops being liquidated up here. Bearish order blocks being respected. Another one over here. Now let's look at market structure. Diving into that 3-minute time frame, right? So we're going into time frame alignment. This time we used a 30-minute order block and we're going into a 3-minute time frame to see if we can spot that silver bullet setup. So we have this market maker sell model formed over here. Sell side liquidity over here. We know the draw is bearish. Price keeps going up and up and up until we go into that higher time frame POI, which is that 30-minute order block, right? Market structure shift to the downside over here, and now we need to wait for that intermediate term high to form, and this time we're going to anticipate a short-term high forming next to it, and that will be our silver bullet, right? Smart money reversal, again in a logical key level, breaking down structure, distribution phase number 1, breaking down further, and then the silver bullet will form. Annotating market structure, short-term high to the left of it, and in that smart money reversal we got that long-term high, right? So short-term high to the left and a short-term high to the left of it, then we have that long-term high and then a short-term high to the right of it, which is in this occasion the low risk sell. Now we're breaking down structure, confirming sell side of the curve, right? Then forming distribution phases over here. Outlining some more structure, right? We have this swing high over here. Now we wait for this swing high to get rated and dropping down further and anticipating this to be an intermediate term high. So immediately our stop loss could be above here once we look for that second stage of distribution, right? That silver bullet setup. Price drops down lower, lower, lower. Sell side liquidity is still intact, right? So our draw on liquidity is still present. We wait for price to go back into a PD array, which in this case is a fair value gap over here, right? It's going into a premium level from this range high to this range low, so that makes sense. And the silver bullet is being formed over here. outlining that mitigation block over here, right? We use those bullish order blocks on the buy side of the curve, extend them out to the sell side of the curve. Is there a fresh PD array formed over here? Yes, there is, right? We've got this fair value gap, and price dips into that fair value gap and declines, completing that sell side liquidity. Right, so we've got a crude oil 4-hour chart, and we're going to be looking in anticipation of an intermediate term low forming in this market maker buy model, right? So what do we have over here? We've got a key level, right? A fair value gap in discount from this range high to this range low. We see we are respecting it and continuing up, leaving behind low resistance liquidity, right? So our eye should immediately go here for the drawn liquidity. Price retraces back into that 4-hour order block, and now we can use time frame alignment, right? 4-hour PD array into a 15-minute market maker buy model, and let's dive in a lower time frame to see what that looks like. So smart money reversal happens over here in that higher time frame POI, right? We've got that 4-hour order block. We've formed a market structure shift up here, low risk buy down here, and then the first stage of accumulation is happening in the next PD array, which is this fair value gap, continuing up, and then we're anticipating this to be the intermediate term low, right? Because the silver bullet is the second stage of accumulation, and now we're anticipating this low to be the intermediate term low. So our silver bullet setup will be a short-term low to the right of it, right? And we need to wait for it to decline into discount and use a fair value gap as an entry. So if I go over here, we can outline those short-term lows, long-term lows, and intermediate term lows in the next slide. But we've got that short-term low down here, right, on that smart money reversal, again on a key level, important. Long-term low down here, because we have a short-term low to the left of it, and a short-term low to the right of it. Bullish order block, supporting price, pushing up, breaking market structure. This is called a low risk buy, right, for smart money. But for us, it's not a low risk buy because it's actually a little bit higher risk for us because we don't know if market structure shift will happen. That's why we wait for that market structure shift. And this whole silver bullet setup is a very solid entry model. We anticipate this low being formed, being the intermediate term low. Why? Because we take out this short term low, right? And then creating another short term low to the right of it. Now marking out your PD arrays, right? Mitigation blocks, breaker blocks, and then premium and discount levels. We've got that bearish order block over here, which is being used to the buy side of the curve, right? So now it's a mitigation block or a breaker block because we took sell side liquidity down here. Is there a PD array formed inside this mitigation or breaker block? Yes, there is, right? Because we have that order block up here. And then a fair value gap combination also. So we have a lot of confluences in this area to anticipate this being the intermediate term low, and the silver bullet setup will be the short term low to the right of it. And then you can see price is very willing to continue up higher and complete that market maker buy model. Right, so over here we've got an E-mini S&P 500 futures chart on a 30-minute. We've got these clean buy stops formed over here, and sell stops have been rated, right? So we've had external range liquidity been taken. We're starting to move up into buy side of the curve, and now we're going to look at a confirmed intermediate term low, right? And we'll dive into the lower time frame for this. We've got this BPR over here, right? That PD array, that redelivered rebalanced PD array. The price is rejecting off that. So again, going into buy side of the curve after hitting a key level, right? That key level over here was the 30-minute BPR or redelivered rebalance PD array. We're in a 3-minute chart right now, so we're doing time frame alignment once again, right? Higher time frame PD array into a lower time frame market maker model. So price is trading up higher right here, continuing up and then forming a short-term low here, and we see this getting rated. So what is this low? Low risk buy, right? But also we have an intermediate term low formed down here. Why? Because we have that short-term low to the left of it, right? And that short-term low to the right of it. Now this is confirmed, right? Instead of anticipating and taking an entry on this short-term low, now we wait for this intermediate term low to be formed and then go into second stage of distribution, which is over here. and that will be the silver bullet setup. So where do you get in? Again, we have that BPR, right? Just like that on the 30-minute time frame, that redelivered, rebalanced PD array. Same thing over here. We have that up, down, and then the next candle up, right? And then we can outline this gap over here, leaving a breakaway gap too over here, because we don't need to go into this fair value gap once there is a BPR formed above it, right? So we have this mitigation block on the left side, right, on the sell side of the curve, which would be a bearish breaker, that would be a bearish order block over here, right, extended out to the buy side of the curve. Now it's overlapping with a new PD array. So again, layering all those confluences, looking at market structure. Do we have an intermediate term low? Yes, we do, right? So ideally, you can take an entry here. If you're very conservative, you can put your stop loss below the intermediate term low, because that for sure should not get rated. But after we already did this entry in this short-term low, I think it would be solid to just have our stop loss below this fair value gap, which should be a breakaway gap anyway, and that would be a very good risk to reward trade. Silver bullet, short-term low.